In this week's video, we'll review the latest charts to help us answer the question, is there light at the end of the bear market tunnel? Maximum flexibility 100% of the time came in handy Thursday morning when the Consumer Price Index was released at 8:30 a.m. Eastern Time. The S&P 500 futures immediately gapped up 100 points. Seen some improvement on this front. Happened Thursday morning. Post-CPI, the Fed, for the most part, is sending signals that they're going to raise by 50 basis points. As we head into next week, these bullet points from the October 21st video are still relevant. When CPI was released, the S&P 500 was able to clear 3915-ish, increasing the odds that the S&P will try to make a run at its 200-day moving average, or possibly even somewhere into the 4200 range. It's an S&P 500 15-minute chart. This is the rally off of the low here on October 13th. These VWAP lines, or volume weighted average price, tell us something about where positions were established and thus give us some insight into market psychology. In the simplest form, these levels represent possible areas of support and resistance. So in the short run, this is an important band in here. We went from giving up that band at the close on Wednesday to recapturing every single one of these levels by the close on Thursday. You can think of this as a failed bearish breakdown. And as you might imagine, the market reacted to that data on Thursday, the better than expected inflation data, and that was reflected in interest rates. And market expectations relative to the Fed's terminal rate, something that we talked about last week, came down. And obviously, that's good for the stock market. And the lower than expected inflation report and the change or drop in interest rates impacted the currency markets. The US dollar starting to take a little bit of a break after running higher most of the year. Thus, it's probably fair to say this bullet point, and this bullet point were all impacted by the CPI report, at least from a probability perspective. And prior to Thursday's report, very lopsided here. It was easy to pick these bullet points down here. Now we've got a little bit more gray area in between the bearish case and the bullish case. The odds of inflation falling in a material manner in the coming months, those odds have picked up a little bit. For clients, this chart should provide some insight relative to our thought process and our allocation changes. These volume-weighted average price lines down here, the fact that the S&P 500 has cleared them, tells us that for the most part, market participants on average that establish positions here, 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 and here are for the most part happy. And they would be most likely more prone to add to those positions rather than cut them. So relative to the S&P 500, between here, this is 12:15 p.m. Eastern Time on Friday, November 11th, and this downward sloping blue trend line up here that comes into place somewhere in the neighborhood of 4200-ish, you can see there are several forms of potential resistance between point A and point B, including the 200-day moving average here dotted red. Hypothetically, if the S&P 500 were to go back and test this downward sloping trend line, and let's just say hypothetically that would come in somewhere around 4,200, that's still about a 5% move. Also noteworthy, these are the volume-weighted average price lines from the COVID low and the COVID peak. You can see the market dropped below them, and now we've recaptured them. This is a very, very important set of lines here. It's concerning when we're below them as we were here in October and pre-CPI, and it's a little bit more encouraging when we can recapture them. Thus, relative to the low versus a counter-trend move argument, a lot of gray area between where we are now and roughly 4,200. Given what we know today, if the market gets up here, and let's say we're similar to this look up here, our base case would be to be skeptical. Probably err on the side of protecting profits if we're fortunate enough to have them up here. Until the market proves otherwise, for the most part, this is more of a trade. But what it allows us to do is balance the risks. If this is the low, staying aligned with the data in here will help us out tremendously if we get to the other side of this line here, and that's all to be determined. In simple terms, if price is between this level and this level, the probability of this being a 100% normal and to be expected counter trend rally within the context of an existing downtrend, those probabilities are higher relative to the probability that this is the low and we will never look back. The more hurdles we can clear in here, and especially the downward sloping trend line and the 200-day moving average, if we're able to get to the other side, that's hypothetical. The longer we stay above the 200-day and the longer we stay above this downward sloping trend line, the higher the odds that this could be the low. It's around 3:40 p.m. Eastern Time on November 11th, Friday. Since we were able to clear 39.14ish this week, what once acted as resistance may now act as support. So there's a little bit of a margin of safety in here, increasing your exposure on the other side of 39.14ish. And the same thing can be said for any additions made in this area here. There's some level or areas of potential support behind us now. Not really the case when you're down here, especially in the short run. The Dow Jones Industrial Average has been the leader off of this low down here. This is a weekly chart. And we're still below a red cloud. For the most part, this is a downtrend, a well-defined intermediate term downtrend. Thus, we should learn something about the rally attempt and the odds related to the S&P 500 and the broader market based on what happens to the Dow Jones Industrial Average in this general area here. And the cloud tends to act as possible resistance. And thus, your leader is near that possible resistance. But the S&P 500, even if this is a counter trend rally, hypothetically relative to the cloud here, could still have significant room to run. You can see the cloud acted as resistance here during the counter trend rally off of the June low. This area in here at 42.25 is also noteworthy. The smaller chart down here is IJH midcaps relative to the S&P 500. Nice basing pattern, very long-term basing pattern, and what looks like a bullish breakout. This is the same ETF, IJH, in isolation. Like the Dow and like value stocks, it's one of the leaders off of this low here. So relative to the odds of the S&P 500 clearing the cloud eventually, or clearing the 200-day moving average, or clearing 4,200, we should learn something about those odds relative to what happens to your leaders in these areas of possible resistance in here. You can see since the market's peaked, the track record in terms of trying to clear this downward sloping trend line is not good. Similar situation here with small cap IWM. Better momentum look recently here. During Friday's session, we were on the other side of what previously was an upward sloping trend line, and we're on the other side of this downward sloping trend line. So the longer that we can stay really in this area here, the higher the odds that, at a minimum, a counter trend rally will continue, and or that this is the low. This is the beginning of a risk-on rally. This is November of 2020. This is the beginning of risk-off here, where ARKK or ARK peaks. This is where the NASDAQ peaks. Probably fair to say this looks more like a risk-on look in here, where we are in the present day, relative to this look here and this look here. Now, having said that, the outperformance in small caps and mid caps has been influenced by the strong dollar, since small and mid cap stocks or companies tend to generate more of their revenue domestically. Having said that, this is still a constructive look. These are the same charts of the S&P 500 index. The only difference is the small chart has price on it, and the large chart lets us focus on the moving averages. Pre-CPI down here, we look very, very dicey. We look like we're going to give up all of the moving averages, and then you can see we catapulted back above them. Probably fair to say this cluster look in here has some similarities to this look here, and maybe this look in here. Like anything else, this look here speaks to probabilities. It doesn't predict anything. When the S&P 500 starts to move off of that October 13th low, we really can't answer this question yes in any shape, form, or fashion. Now that changed a little bit after CPI. This is a 10-year yield here, 20-day moving average after CPI dropped below it for the first time in quite some time. And now we have a lower high here relative to this high, and now we have a lower low here relative to this low. So we've seen an improvement in interest rates, and we've also seen an improvement relative to Fed expectations, which speaks to that terminal rate. You may remember recently we looked at the ratio of the 10-year yield relative to the S&P 500. This is a weekly chart, and we compared it to the look during the bottoming process in the S&P 500 at the end of the 1973-74 bear market. A few weeks ago, we really didn't look anything like the bottoming process. Not so anymore. We're starting to take on a deteriorating momentum look here. Momentum looks like it's trying to roll over. And this speaks to improving odds for A, a counter-trend move, or B, that the low could be in place. This is the 20-day moving average, and this is a short-term look. If we look at the weekly cloud, there's no question the trend in interest rates is still up and still unfavorable for the stock market. But strength and/or weakness in the US dollar is somewhat reflective of interest rate expectations. This is the US dollar as of the close on November 10th. This is the daily cloud, noticeably weaker here. And this is unquestionably a deteriorating look in the US dollar. Lagging span, below price. Price below the cloud. Blue below red. And it's hard to see, but the cloud on the daily chart for the US dollar just now starting to turn red as of Thursday's close. This is UUP, or the ETF that tracks the US dollar. This is during Friday's session on November 11th at 1:29 p.m. Eastern Time. Very, very similar deteriorating look from a shorter term perspective. We can go all the way back here to March, and there's no question this is the most vulnerable look here on the daily chart of the dollar. Like anything else, doesn't predict anything, it just speaks to odds. And a week ago, the Fed really didn't have anything on this bullet point here. Nothing earth-shattering this week, but there's no question this is good news for the Fed. And last week when we were covering or dissecting the Fed speak, this was really the only text that we said leaned bullish. And as it turned out, at least this week, it did turn out to have some predictive validity. It's a 195-minute NYA or NYSE composite chart. Friday's session around 1 p.m. Eastern Time, trying to clear this downward sloping trend line that goes back to April above a green cloud. This would be full bore bullish in terms of the daily cloud, or the 195 cloud, I should say, 195 minute. Having said all of that, 200-day moving average, downward sloping 200-day moving average being tested during Friday's session. So we'll learn something about the S&P 500's rally based on what happens here with the NYSE in the coming days and weeks. This also represents strong potential resistance up in this area here. So even if we clear the 200-day, we should keep this in mind as well. Some evidence on these charts of improving trends. S&P 500 50 days starting to flatten out a little bit during Friday's session. The Nasdaq's 20-day looks a lot better than it did here. And on the interest rate front, 20-day moving average for IEF looks a little bit more constructive for the stock market than it did back here. Now, admittedly, these are baby steps, but incremental steps nonetheless. The basic tenet of trend following is when a market gets extended from the trend, it has a tendency to come back to the trend. When a market gets extended from a trend, or a data set gets extended, has a tendency to come back to the longer term trend. This is NYSE Advanced Decline Volume. It's a monthly chart going back to 1998. You can see the breadth indicator made a stand here. S&P 500 bottoms in March of 2009. Made a stand here, January 2016. S&P 500 bottoms in early February 2016. And we're in the same general vicinity in the present day. Here, we're below the lower Bollinger Band, meaning we're extended in one direction. Below the lower Bollinger Band here, and we dropped below it recently as well. Just tells us to keep an open mind about better than expected outcomes walking forward. When the market's trying to right itself in here in late September, early October, there's really not a lot of risk on in terms of the look or the feel for the markets. That starts to change in here and changed again this week when CPI was released. So this is the S&P 500 down here. Pretty easy to make the argument that this look in this range here is similar to the period where at least we had a counter trend rally from the June low to this August high. So there's no question risk appetite has improved significantly, let's say in the last 5 or 6 sessions even. Well, not surprising since we got a better than expected CPI report or some good news on the inflation front. Source of the chart here, original source of the chart here. These are 913 sequential counts, exhaustion counts, potential bullish exhaustion, trend exhaustion applied to the consumer price index. Here's a 9 paired with a 13. It's just another reason to keep an open mind about inflation peaking or starting to peak. This is an aggregate indicator. It's the advanced decline line for the American Stock Exchange, the NASDAQ Composite, and the NYSE Composite. Advancing issues minus declining issues. This is how crazy things have been lately. Down here around negative 5,500. This week up here in a very, very rare area, positive 5,500. This is NASDAQ new highs. Here we are here, Q4 of last year. Haven't been this high since Q4 of last year until recently. It's a subtle change, but it leans bullish. Now, we know that bear markets associated with recessions tend to last longer in duration and tend to have bigger drawdowns in terms of magnitude. You can't see the dates on this chart, but this is the dot-com bust bear market. This is industrial production during a recession, a significant recession. And this is industrial production during a very significant recession, the financial crisis, 2007 to 2009. And here's industrial production during the COVID crash. And here's the same data in the present day. This is the most recent data point that we have in 2022. It's very, very difficult to look at this chart and then not come down here and say we can check this box. And if we do get a soft landing, and that's to be determined, then the odds of the low being in place would also be higher. Notice we're talking about odds. This is a region in here that we've been talking about for a long time in these videos. This is the September, October, November region, and this is the NASDAQ. This is the cluster that we've talked about in the past. This is volume by price here since, for the most part, COVID. We've been on the wrong side of that volume by price bar several times in here, but as of the close on Thursday, November 10th, we're holding, and that's significant. And even if the NASDAQ only rallies back to this trend line here, that's a significant move potentially over the next few weeks. It's a long-term trend in the NASDAQ. This is the low in 2009. This is the COVID low. This is the 200-week moving average. This is the present day. For the most part, we've come back to the pre-COVID high here before the COVID plunge. If we don't hold in here, this would be an area down here of stronger potential support. This is the broad Dow Jones Composite average. Thus far, the weekly chart has held near very logical levels. This is the gap up here from that cluster that we were just talking about, September, October, November 2020. There's a gap on the weekly chart. Here's the gap down for COVID. Came back into that area and thus far have held, and that's also where the upward sloping 200-week resides in the present day. This was the concerning look on the weekly chart momentum-wise. It's much improved as of November 10th. That would be the good news. The bad news would be this is still a clear downtrend until proven otherwise. Another leader here, so we'll learn something about the S&P and the NASDAQ relative to what happens with the Dow Jones Composite. Until very, very recently, we hadn't seen much in terms of encouraging looks in the credit markets. Corporate bonds have been rallying, and if you're a stock market bull, this is 2008 here. Here's where we bottom in the stock market. This is 2002 here. Low in the stock market comes in October of 2002. So if you're a bull, you would like to see corporate bonds continue their current rally. The longer this index holds above the red 200-week moving average, the better. The more this look here morphs into a look like this, the more concerning it would become. Peak in home construction. This is as the housing bubble was popping. Early stages of the financial crisis. What once acted as strong resistance may now act as support. What once acted as resistance here in early 2020, what once acted as resistance here in 2018, may now act as possible support. Also comes in near that upward sloping 200-week moving average. Demographics say we shouldn't discount home construction holding in this area. If the secular bull market is going to resume, for the most part, the demographic argument that we just made with the last chart would apply to investment services and the high here pre-financial crisis, this high here, this high here. What once acted as resistance may now act as support. We didn't come all the way down there, so that leaves the door open to further downside. However, we've held the trend line for the most part, dating back to the 2009 low, and thus far we've held above an upward sloping 200-week moving average. Everything that we just said about the last chart from a trend perspective applies to this chart. This is 2009. Here, this is October of 2008. This is where the S&P bottomed here. You can see semiconductors bottomed first. It's a little early on the breadth thrust front. I said the Dow's been a leader. It's pretty rare to see the percent of Dow stocks above the 50-day simple moving average move from this oversold level down here all the way up to the upper blue line. It's only happened a handful of times after the major low, 2003 here. The low was October of 2002. After the major low in March of 2009, after the low in 2010, after the October low in 2011, and after that retest low in early February of 2016, after the Fed pivot here, Christmas Eve 2018, and after the COVID low, and the present day. In the historical cases, the average and median drawdowns in the S&P 500 very muted. Noteworthy that the hypothetical pullback level is that 3914-ish that we've been talking about, so this would be hypothetical support. Historical cases after a similar look, something that just happened in the present day, average gain in the S&P 500 somewhere in the neighborhood of 17-18%, 2 years out 33%, 3 years out almost 46%. Simply telling us to keep an open mind about better than expected outcomes. This indicator is based on the 50-day simple moving average. Very similar and constructive historical looks using the 150-day as well. It's a Dow a little over a week ago, November 3rd. This looks like a solid rejection here. Logical area, downward sloping trend line, downward sloping 200-day moving average in red. If we fast forward to post CPI, this is the close as of Thursday, November 10th. This looks different, really, than anything that we've seen since the peak here. These are significant risk-off gap downs here in June, back above both of those levels as of Thursday's close. 50-day moving average in blue trying to turn back up in a constructive, probabilistic manner. Remember, we'll learn something relative to what happens with the leaders. Strong possible resistance above here, possible resistance here on the daily chart, weekly cloud resistance here. Here's where the stock market peaks. This data set has not looked this good the entire year for the most part. If you pause your video player here, hard to make the argument that this is not a constructive look here from very, very oversold levels. When the indicator was that oversold down here and it reached this level, in this case the low was in. Not predicting anything here, trying to make a stand at that upward sloping 200 week. NYSE Composite, 1965 here, lower left-hand corner. You can pause your video player here. But we've come back to a very logical area here in the present day. This is the recent low on the monthly chart. A lot of resistance in the rearview mirror here starting in 2018. This is the COVID peak. Now, thus far, we've made a stand at a 50-month moving average in blue and near a logical area. It's not uncommon to have big rallies, retracements back to logical areas. Big rally, retracement back to a logical area. Big rally, retracement back to a logical area. Just as this is potentially significant that it's holding, it would also be significant if it didn't hold. That's to be determined. Last week, during the session a week ago, intra-week on Friday a week ago, we were below this red line. That's not a good look. We reversed during Friday's session a week ago, and now we're above the red line. From a probability perspective, it increases the odds that you're going to make a push back towards the cloud. Logical area to make a stand, logical area to make a stand, 200-week logical area to make a stand. The longer we hold, the more relevant it becomes. And if we don't hold, that's also very relevant. A lot of similar looks in the present day to this area here in July where the market took another leg up, including this look here. Broad 1500 composite S&P. Downward sloping trend line. Step 1, we break the trend line. Step 2, we make a higher low relative to this low. And step 3 this week, after CPI, this is Thursday's session, we make a higher high. That would also be similar to this general area in here in July. You can pause your video player here, but for the most part, thus far, monthly RSI has held at important levels. If it looks more like this walking forward, that would be concerning. 2009 here, this is the COVID plunge here. Trying to make a stand in a logical area here in the present day. That's to be determined. Still haven't come back to this level here. That may happen in the coming weeks. Back into this important area here. Visually, you can see where 4,200 hypothetically might come into play. If you pause your video player here, typically when you get a monthly close, as we recently did below the 40-month moving average in red, and then you get a close back above it, that's typically a good thing. This is 1973 back here. Trying to make a stand at that 200-week moving average. This is 1930 back here. It's a zoomed-in look at the 200-week moving average in red. Present day up here for your typical stock. This is the very long-term approximate trend dating back to 1974. Is it possible to drop below the trend line? Absolutely, positively, yes, but we haven't done it yet. Also above an upward sloping 50-month moving average in blue currently. Another method to get a much broader read on the stock market. This is 1998 back here, trying to make a stand in that general area. We don't look as good as the 1962 case, but we are trying to improve here. These are some moving averages here used by the market model. This is the 1962 look. We took off after we cleared these MAs in here, trying to do something similar in the present day. We look a lot better here than we did here in early November. Here's the bigger look at that 1962 case, and our scores relative to the special situation model much improved this week relative to last week. Still have work to do. This is still a downtrend. All of this applied on September 9th. It still applies. All of this is still relevant, especially bullet point number 1 here. These are the bullet points from last week. Fair to say the odds of this happening are higher today than they were even a week ago. LQD has recaptured this COVID gap here. Better look in terms of momentum and a better look on the daily cloud. Still has work to do. Might speak to future economic outcomes. This is after the major low in 2009. This is the present day. On the other side of the coin, massive potential resistance. Here's that risk-on look from November of 2020. This is a very interesting look here. Downward sloping trend line, upward sloping trend line, tight cluster with the MAs. This is Friday's session, 1:24 p.m. Eastern Time. Probably fair to say this look here looks a lot more like this risk-on period here in November of 2020. It really doesn't look anything like the COVID plunge. That can change quickly if we move back into this area here. What once acted as resistance may now act as support. This is 2014, 2018, 2022. The dollar-based ETF divided by the S&P 500 gets rejected here near a low in 2010 in the stock market, drops here near the low in 2011, drops here near the low in 2016, drops here near the low Christmas Eve 2018, hits the trend line here and drops near the COVID low. We're in the same general area in the present day. Just as this speaks to odds, it would also speak to odds if we get to the other side of the trend line. Best looking weekly cloud, energy. This looks like a bullish breakout for XLE, then it looks like a failed breakout or a retest, and now it's starting to look more like a successful bullish breakout and retest. Been consolidating and moving sideways since June. Given the weighting in the S&P 500 index, if you're a stock market bull, you'd really like to see XLK change the look of the trend in the rearview mirror. Not uncommon for extended markets or ratios extended from the 200-week moving average. Instead of plunging, they go sideways and almost let the moving average of the trend catch up. That's one possibility, XLK divided by SPY. If you're a stock market bear, you could make the same argument here. Extended from the 200-day, it's possible, just letting the trend catch up. Probably fair to say things have improved significantly since last week. Inflation came in below expectations. Interest rates dropped. Interest rate expectations are lower today than they were a week ago. The odds of a 75 basis point hike are significantly lower today than they were a week ago. 19% today relative to 39% a week ago. The US dollar has finally weakened a little bit, something that tends to lean bullish for risk on. And after CPI, Loretta Mester of the Fed gave a talk, something that we listened to. We listened to every word of it. She really didn't appear to be talking down the market. And interest rates held firm, even when she was saying things that tended to be bearish for the stock market in the past. Her talk was a big test for the post-CPI rally attempt. It felt like intraday that the market was going to pause during her talk and then it was going to rally further after her talk, and that is what happened. Given these improvements, which speak to odds, we're taking a little bit more of a balanced approach than we were even a week ago. Fair to say that the odds of the low being in place are higher today than they were a week ago, but they're still lower than the counter trend move odds. Why? We're still in a downtrend until proven otherwise. And that includes the Dow as well. Markets need to prove it. Really nothing new here. We'll continue to assess the odds of the low being in place on a day-by-day basis. We'll look at the weight of the evidence and adjust accordingly. Wide range of 200-day moving averages. Leaders, the market itself, and laggards will learn something. S&P sits at roughly 4,100-ish. That downward sloping trend line comes in closer to 4,200-ish, where we failed in the past, so that would be a big test if we can get back there. It's very difficult to take this rally seriously until, let's say, the last 5 or 6 sessions. In the last 5 or 6 sessions, we've seen a broader risk-on look, similar to what we saw in July when the market took another leg up. There's still some potential upside here. 4,200 is approximately 5% higher from where we were during Friday's session. Here's a little tip for all of us from the Fed, planted in the Wall Street Journal, relative to what they'll be watching in the coming days and weeks. The Fed really doesn't know exactly what the terminal rate is at this point. They're taking it day by day. It's important that we do the same thing. A potential rally killer in the coming days and weeks, if we see economic data that just screams recession, that could spook the markets. Given the trends are still down and given the market's track record for failed rally attempts, until proven otherwise, any positions that we have a shorter leash, even shorter than the leash they were given after the June low. There's nothing wrong with maintaining a healthy distrust of any rally in this environment. Trades can turn into investments, but the data needs to improve for that to happen. Our allocations reflect the improvement in the data. It's not significant at this point, and the Fed could get very, very difficult again if they don't see what they want to see. The magnitude and the duration of the declines and where we are in the interest rate cycle, and possibly the inflation cycle, say longer-term odds are improving. The odds that the market will be higher a year from today are for the most part improving day by day. There are a lot of moving parts in this market. It remains extremely complex. And thus, we all know, the only way any of this works is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.